The Fed kicking off its two-day policy meeting. It's widely expected, to deliver a 25 basis point hike at its conclusion tomorrow. Joining us now, Meghan Graper. She's now the global co-head of debt capital markets at Barclays. This is what you do, Meghan. So where are we? We 80%? Where are we for today? What are the comments going to feel like? And then what about at the next meeting? What are the prospects?
Yeah, it's about a 96% probability baked in here. So while I think you could argue we're operating in a backdrop where recent data has effectively bought the market and the Fed a bit more time to assess the impact of previous hikes. We've had 10 hikes now. You think it's all but certain the Fed is going to move forward with that 25 basis point hike at tomorrow's meeting. That's in line with the June statement. It's in line with the most recent dot plot, and it's consistent with the Fed speak we heard prior to their blackout. So I think while Powell is likely to acknowledge that inflation is actually trending in the right direction, I think very quickly the focus in the Q&A is going to shift to reinforce that their 2% inflation target is far from mission accomplished. I mean, you've got a labor market that remains exceptionally tight. You've got nominal wages that are still high and supporting consumption. And you got a housing market that has bottomed out. So a lot has to go right for them to reach a 2 handle on core PCE in 2024. And so I think, you're going to see with 2 employment releases and 2 CPI prints before the September meeting, an ability for him to retain optionality here. I think there's zero upside to him being much more prescriptive until that end game is more clearly in their line of sight.
Think if they did go 25 today and then another 25, how far the 10-year is from where it really should be if it really believed that the Fed was going to remain firm in its resolve. So are they counting on bond market participants to finally find religion, to finally buy into what the Fed is telling them? Because they're just going to they're going to move it further and further away from reality. What's going to finally happen? The Fed going to have to admit could they be wrong and they come back down to the 10-year, or is the 10-year going to slowly, gradually get up to 4.5% or 5%?
I think we're going to be a bit more range bound. I think what's surprising, if you look at sort of the 65% probability of a recession over the next year, which is where we were and was consensus at the start of the year, that number effectively hasn't budged. I think what has changed is the timing and the magnitude. So we're pushed out from the first half to a late Q4, early Q1 recession. And I think there's an increasingly pervasive view that that's going to be a more mild recession. So if those expectations ultimately play out, I think that factors into the path of rates ahead. And should a recession remain more elusive, which is really the baseline in our view, yields may actually be biased higher as those cuts get pushed out even further and the Fed is on hold for longer. I don't think that's baked into the market. We're already pricing in a cut by Q1 of next year and 150 basis points of cuts prior to January 2025. So I think you'd have to take a view that we're moving into a much more severe recession and sooner than the market's currently pricing in to actually see the 10-year rate rally that has become sort of the overarching view of many market participants.
Meg, is the Fed counting on a recession? If they got their heart set on a recession, are they not going to be happy till they actually cause a slowdown? Wouldn't it be possible for inflation to cooperate and not do it that way by causing higher unemployment and a business slowdown? Wouldn't that be better if they could walk that line?
Yeah, it is, and they might achieve that balance. Patience ultimately might be the name of the game here. The economy is much more stable than anyone had feared. So unless the Fed over tightens, it's admittedly, I think, hard to fight this more rose-colored glass scenario of disinflation and steady U.S. growth. I think, they could be very willing to wait a long period of time. So just hike an additional 2 times here. So one tomorrow and another hike in either September or November, and wait for that to feed into the market. So I don't think they need to be rash in their decision making here. I mean, they don't need to be preemptive in making that call. There's a lot of data ahead to try to gauge that view and how aggressive they need to be. So there's a lag effect here that I think they clearly want to evaluate. I don't think it's our baseline expectation that they send us into a deep recession. So, a mild one is still the baseline call, but I think it'll be manageable and not be quite as detrimental to the employment picture as some are hypothesizing.
So what do you think over the next, just real quickly, what do you think over the next 5 years, Meghan? What's the right interest rate level historically? Because having been, gotten in the business in the 80s and watching everything, zero's low. I know that. It's hard to go, but we did go below it, which is insane, negative interest rate. But 2 and 3 sounds low. This does seem kind of like normalized. Could we stay here? Could we average this where we are when the Fed's finished? Could we average that for the next 5 years? Could it be above that for the next 5 years? Do we go back down to much lower? People are waiting for cuts. Why do we need cuts when 5% or whatever is not really a ridiculous rate to charge on money?
Yeah, I mean, I think if you look at our deficit, I think funding that in a higher rate environment is going to be problematic. So I do think we see cuts, but I think we settle back in somewhere in the 2.5–3% mark as opposed to staying here as our baseline view. Over the near term, it's probably a 10 to 20 basis point move versus the 60 basis point rally that you tend to see. If you go back to 1960, that's the average move on the 10-year note, but in the 6 and 12 months following the last hike. I don't think we see that type of view given how low our starting point actually is, but I do think you're going to see some marginal improvement from here over 5 years. That 2.5–3% mark, I think at least over the medium term is probably the right end outcome.